and whether or not, Chinese open source, open weight models take over completely or just provide margin pressure that changes the math for a lot of other players in the market.
Let's talk about Reflection. They're definitely in the game. They're definitely a player to be considered very seriously, and they have a big advantage because they're an American, they're not Chinese.
At one point, I think Forbes called us the fastest growing company of all time. We hit $1 billion in revenue in less than 2 years. I think we're about to witness a big evolution in the private market. I think people have tasted what the private market is and are paying attention to it today in a way that they haven't been before.
Welcome to another episode of our very bad, horrible, terrible VC secondary podcast, Trading Places. All right, well, let's do a rundown of this week's news. We've been off for a week, so we're kind of catching up a little bit here. We're going to talk through Setter's top 30 on their secondary scoreboard. Setter is an advisor for the secondary market and helps manage and broker several deals there. We'll cover a little bit about the Anthropic, Fable, Mythos, on again, off again, ceasefire. I think we're under a ceasefire now. U.S. is not throwing shots at Anthropic anymore. OpenAI released their new product, GPT 5.6, affectionately named Sol, Terra, and Luna. We're seeing a lot of conversations about the cost of computing in AI and whether Chinese open weight models or other US-based open source models are going to put pressure on margins for the top frontier labs. Along with that, Meta just released their new Muse Spark 1.1 version, which is actually seemingly doing quite well. And following in the footsteps of Elon Musk, they're going to also rent out computes and become an official hyperscaler. Kind of been an unofficial hyperscaler in the past. On the valuations and IPOs and raised market, SKHY, not really an IPO per se, but a foreign public company out of Korea that's now debuting in the US and did quite well. Blue Origin, a company founded by Jeff Bezos, competing with SpaceX, raised $10 billion on a $130 billion valuation.
Holy cow.
130 billion, not really that big anymore, given that SpaceX launched at 1.5 trillion.
Sure. But that's a seed round, Dave. That's a Blue Origin seed. It's a founder-led seed round. So give them credit, buddy.
Last on the list, Kalshi raising at 40 billion. That's in the prediction market. Maybe jumping ahead of Polymarket. I guess maybe Polymarket will be catching up later in the year. Well, let's get started with our assessment of where things are happening. We're gonna show a little bit of where the Setter top 30 companies are on their list. We've often covered the top 20 from Augment Software's perspective, but Setter is another secondary provider. Anything surprising to you on this list? This is kind of showing people moving around from Q1 to Q2. SpaceX no longer on the list. I guess,
right.
They're probably a public company now. So the top 5, no real surprises there. Anthropic, Anduril, OpenAI, Databricks, and Stripe. Polymarket
Right.
now also high on that list. Kalshi not too far behind.
Yeah.
And then we get into a lot more companies that seem like they're very hardware focused, defense tech focused, physical bits, if you will. Are we seeing sort of the emergence of hardware companies, defense tech, software versus software?
Yes, it seems like it. So SpaceX is off the list. They got called up to the majors. They're out of the minor leagues and got called up to the show. I don't think they're going to get sent back down. So they're off the list. And by virtue of that, I can't argue with Anthropic or Anduril being 1, 2. OpenAI getting a little bit ahead of Stripe, maybe getting promoted seems a little bit of a surprise that they're moving up in Q2, but I guess Setter is doing this based on demand from buyers coming in. And so, although we've heard some noise about OpenAI, it seems like there is demand from buyers. So that's maybe not that surprising. The defense areas you're talking about, we're seeing Saronic on the list, Shield AI moving up a little bit. So that would seem to be part of the story. And Figure AI got a big jump. I know they're generating revenue. I don't know how much. And Neuralink getting a little bit of a bump. I don't think they're generating any commercial revenue. So there are some
Right.
surprises that these companies that are AI and robotics continue to get promoted. That does seem like a theme in Q2.
I think we're definitely still seeing the frontier labs at the top of the list, and then several, defense tech and other, chips, AI, data centers, et cetera. But it certainly seems like people are a little bit nervous about software outside of just, pure AI LLMs, and they're
Yeah,
more comfortable with hardware. Is
yeah.
that because people don't feel like hardware is going to be disrupted as quickly by AI? Or is it just that we're seeing the hardware equivalent of AI with some of these companies?
I don't know. I mean, I'm seeing Revolut and Stripe move a little bit down the list, and it's all relative, I guess. But I'm seeing some of those non-AI software intense businesses that have great businesses, very profitable, making money, nothing wrong with them, growing at 40, 50, 60% year over year, but not AI native and not AI focused. In fact, they're moving down and being replaced by some of the robotics or defense tech companies. I guess it shows you that's where the flavor is for the family offices and folks who are working with Setter, maybe some of the institutions as well. I think those robotics companies have just discovered, it used to be said around the valley that hard things are hard. Nobody wanted to do hardware robotics. And that taboo is broken. And now there's a flood of money coming in. And the fact that SpaceX and a few others have now gotten public and shown there's public market demand for it. Cerebras is another very physical AI company that's gotten out and shown public company demand. It's just proving that story, and that's what the family offices and small institutions are responding to.
How do you think people think about these top companies? Are these all narrative driven companies? Are they valuation driven companies? Are they revenue or growth driven companies?
I think the LLMs, in particular, OpenAI and Anthropic, they've got real businesses. I think Anthropic in particular is very close to profitability. We're going to cover OpenAI and their new Chat GPT 5.6 in the next story. But I think they've proven they can make money, they can monetize, and they are being based on valuations. I would even say fundamentals. They might be speculative, but you're looking at the next 2 to 3 years of revenues and profits for those companies. I think the robotics ones, the Figure and Neuralink in particular, seem to be much more speculative and maybe narrative, but I think those are the exceptions. I think more and more these are real businesses generating real cash flows and profits at the top of the list.
You are the worst anchorman I have ever seen.
But what did I do wrong? Name one thing.
Well, moving on to other big news. A couple weeks back, there was a lot of fear, uncertainty, and doubt around the U.S. government restricting access to Anthropic's new Claude Fable 5 and Mythos 5 models. That's somewhat, those storm clouds have been cleared now. The Trump administration has lifted export controls. Those models are now available, at least to U.S. buyers, maybe not Chinese buyers. But has this ended the war on frontier models being overtaken by U.S. government, or do you think there's going to be continued oversight by the U.S. government as Anthropic and OpenAI and others release their models?
You remember we talked about this a couple of weeks ago, and I thought it was a little bit overblown to describe what the U.S. government had done to Anthropic as a declaration of war. I think what had happened is Anthropic had launched a very powerful model that they themselves had been saying as late as April, this could override a lot of the safety protocols on the internet. And we want to go slow and want to go through our partners. And this is what eventually became, it was called Mythos back then. They called it Fable 5. And then it went into the sandbox, and one of their key partners, Amazon, flagged it as saying, hey, we think this actually is jumping the guardrails. And for whatever reason, despite being warned about that, Anthropic didn't take it immediately back off the market, and they kept pushing forward. And then I think just to use a World Cup soccer metaphor, that's when the Secretary of, I guess it was Secretary of Commerce, Letnick, came in and threw the red flag and called the foul. And now it seems like it's game on, but I would have thought there would just be a better communication between Anthropic and the government. So I'm glad it's resolved. OpenAI just launched its new Chat 5.6 model, and that seems to be just as powerful as Fable. And that seems to have cleared the market, not have the same Commerce Department control. So I guess that's good news. I still think, though, that there's a lot of tension and a lot of concern about AI and what it can do to the current software protocols and the safety environment. And so I wouldn't be surprised if this is going to be a little bit of a back and forth between the major companies and the I guess the State Department, or more specifically the Commerce Department, which has the ability to levy export controls.
One thing that was raised in that discussion and even floated by OpenAI and Sam Altman was whether they might give 5% of the company to some kind of government-owned sovereign wealth fund that was, run by the U.S. I think Bernie Sanders had even floated a number that was like 50%, which I think probably is not
Right.
super likely to happen. Are we still in this kind of scenario where we're thinking the government might want to take a chunk out of both companies and, hold that on behalf of all of the U.S. citizens?
I have not heard a real serious proposal on why that amount of money, that amount of equity should be taken away from leading companies. This was never a conversation with the internet companies of the 1990s, the e-commerce revolution, the computing revolution. I don't think Bill Gates ever volunteered 5% of his company to the government. I'm quite sure Henry Ford and Alfred Sloan didn't offer up 5% of their companies to Teddy Roosevelt and the governments at the time. I don't know what game Sam Altman is playing. I think it's insane to offer up your company and think you're just going to appease, the regulators or Bernie Sanders. I think you're only going to embolden them. Usually a sovereign wealth fund invests in companies. It doesn't just take equity in them. So
I think this is Sam pulling a page from Elon Musk's book, and like Elon was trying to get SpaceX into the NASDAQ and S&P 500 indexes, Sam was trying to get OpenAI valued at $1 trillion based on the U.S. government taking a 5% stake and paying them 40-50 billion for that stake. Don't you think that's, he's going to try.
different. Yeah. I don't think it's going to end well if it's just given away for free. I don't think it's going to be happy shareholder meeting. But if he can sell it to them or somehow get a valuation or get some consideration, that's a different story.
Korean soldiers were fired upon in the DMZ! Oh, geez, I am so sorry. Someone put the story in all capital letters.
In other OpenAI news, they recently launched GPT 5.6, and getting away from nerdy versioning models, have now called their releases Sol, Terra, and Luna. That's the sun, earth, and moon in varying levels of sophistication and cost.
I think the fact they're launching 3 different models at the same time is actually, it's fantastic. You've got Sol, which is the flagship. I guess it's the smartest, most powerful model around, but it's also the most expensive. Their API pricing is $5 per million tokens for input, and then $30 per million output tokens. But then you got Terra, which is more standard enterprise logic, and that's half the price. And then you've got Luna, which is high throughput, lowest cost efficiency, and 60% cheaper than Terra. So now they were enabling multi-tier routing. So a team no longer has to go with one monolithic app to go on the most expensive model. You can basically build an agent stack that uses Luna for triage and can classify incoming requests for much cheaper. You can move, if that fails, you can go to Terra, and if that fails, then you go to Sol. It's a much more cost-efficient way to route tasks to where they need to be. So I love what they're doing here.
I feel like the cost and pricing issues are coming up in several stories that we've been talking about. I think a few weeks ago, Coinbase CEO Brian Armstrong talked about cutting their costs in half by using some internal routing tools that weren't always, using the most expensive models for basic tasks, and really able to save money by shifting some of their demand to different platforms, open weight models that might be lower cost.
Every CFO is going to sit down with their tech team and say, hey, let's work on this chart together. And I want you to map out for me open versus closed for our business. So on the y-axis is an AI index, which is basically a composite benchmark of effectiveness. How effective is the model to do what our business needs to do given a series of highly challenging evaluations? On the x-axis is cost. And this is actually a logarithmic scale. So the cost will range from like $30 for 1 million tokens on the left all the way up to $10,000 on the right. And it's logarithmic. So the numbers will rapidly increase the more you get to the right. And I think what every business has to do is what I'm going to do now. I'm just using information from artificial analysis.ai and just making it a little bit generic. But on the right, you've got Fable 5. You've got all the Anthropic players. So Fable 5, Opus 4.8, and 4.6. And then you've got ChatGPT, and the new one is 5.6. They have 5.5 and 5.4. And so you are going to have the very expensive but highly effective closed weight models on the far right. And I think every company, every enterprise needs to know, does this work for my business or not? But now look, there's some others that are in the game. So Gemini has both Flash and Pro. You've got Kimi K2.6, which is in the conversation, and it is Moonshot AI, such a Chinese open weight company. And then this top left box is becoming interesting now. So we now have DeepSeek, Pro and Flash, and then Minimax, which are open weight models, Chinese, and they're in that top left, let's call it the value quadrant. This is where you're like 80% as effective as some of the Anthropic stuff, but like at 20% the cost. So if you are a business, you can save a lot of money. You don't have the same efficacy, but it may be a lot more cost efficient. And there are some other players there now, like Xiaomi has a model called MIMO 2.5 Pro, which is definitely in that value space. Z.ai, another Chinese open weight company, has GLM 5.1 and 5.2. Those are in the conversation. And then I think you've got, Nemotron's another one. That is open weight. That is definitely in the conversation. It's by NVIDIA, so it's still a little bit early, but they are open, meaning that they publish their model weights completely free on Hugging Face and other platforms. They don't make any money by restricting access by a proprietary API gateway. And then Grok is in the game, and Grok is, I'm going to call it closed weight. That may be weird because Elon is the biggest defender of open weight models that there is, and the early versions of Grok were open weight. But with this new Grok, which is in the conversation, you cannot download their weights, and you have to pay for commercial API access or access them natively inside of tools like Cursor. So now I think you've got a conversation with CFOs and CTOs on what of these models do you do for what? And you just mentioned it. Brian Armstrong said he's going to cut his token expense by 50%. So he's figured out a way to cut the expenses. I think DoorDash can do it. When you have a task that's well defined and you know what to do, I think these open source models can work great. So for immature tasks, I think for the cutting edge stuff, it still is going to pay to go to the closed source stuff and the frontier models. And it seems like their token usage is growing and that they're all making a lot of money. We talked about Anthropic at 60 billion in ARR now in revenue, and OpenAI probably not quite there, but right behind, and they're 5 to 10xing year over year. So I don't think they've lost market share yet to the open weights just based on revenue, but that may not be the best way to measure revenue because of the way that these things monetize. And it may be that these Chinese open weight models now and Reflection are closing the gap. So I think this is an ongoing conversation, and there's more and more pressure building on the closed sources.
I feel like the overall AI market, we're certainly seeing a lot more choices and options, which is good. But I think we're also going to see more pressure on the margins of the leading, frontier models. And I wonder if that also results in slightly slower growth. We'll see if kind of like all the acceleration that's been happening with Anthropic continues, or whether, combination of the government moves and maybe just all this competition from other open source players changes their math. But I would guess we'd see a little bit of a slowdown in growth or revenue. And whether or not, Chinese open source open weight models take over completely or just provide margin pressure, that changes the math for a lot of other players in the market.
Yeah, no question. I guess the good news is for these guys, if you're growing at 5 or 10x a year, and now you slow down to only 2x a year on 60 billion in revenue, that's still a pretty valuable company. But I'll go back to what you said OpenAI did, which is they launched 3 models, not one, and they're 3 different models at 3 different price points with 3 different levels of efficacy. So they're now anticipating that CFOs and CTOs are going to want to do routing across different types of models, and they're trying to offer something at the low end, something at the mid end, and then something at the high end, so that they don't entirely lose share to the open weight. So it's definitely affecting their product strategy, and yes, it'll probably slow their growth down.
I didn't know how to make sense out of it.
None of us understand.
Why?
Our next story is a similar vein. Meta is planning to launch a cloud computing option, and they also did announce Muse Spark version 1.1, which is a coding and AI platform model. So both of these are sort of new strategies, new directions for Meta. In the one sense, they're following in Elon's footsteps to offer a cloud business to other parties than just themselves. And I guess that puts them into the hyperscaler conversation along with Amazon and Google and Microsoft. Any changes there, or does that sort of seem like a natural progression given their spending a lot of money and have to justify how they pay for that spend to the rest of the market.
So you mentioned the three hyperscalers, the ones with cloud businesses. So far, year to date, Amazon stock is up 8%. Google is up 13%. So is NVIDIA. Microsoft is down 19% year to date. So the market hasn't loved Microsoft, but I think in general, with all the capex going in, the cloud players and the hyperscalers with cloud businesses have done great. Up until June 30th, Meta was down about 18% year to date. Since they made the announcement of kind of getting into the hyperscaler business and renting out their compute, they're now flat. So they're actually up about 20% from the announcement. And I guess that says, hey, the market loved it. My reaction was, it's about freaking time. Why didn't you launch this thing 3 months ago? Like, what were you waiting for? Those who can do, like Amazon, Microsoft, Google have been doing it. We now have two examples of those who cannot do, taking their compute, right? Like my SpaceX first with, and now Meta. SpaceX had Grok. They built a lot of compute with Colossus. Grok didn't really have enough demand to kind of use all their capacity. What do? They leased it out, and they've turned that into tens of billions in revenue. Meta now had Llama. Llama hasn't really gone anywhere. Doesn't have a lot of demand. They have a lot of excess capacity. Now they'll see if they can rent that out. So I think that's a natural progression for their business. It's a no-brainer. And, the market is telling you what the answer is, which is probably should have done this about 3 months ago.
Okay, another story we're going to cover today is SKHY's listing in U.S. This was a company that was already public in Korea, but they did a U.S. listing, and that went extremely well. The company raised about $26 billion on that U.S. offering. And this is a company that sells chips and memory, and some of their largest customers are data centers.
I'm not sure many people know about this company. It's up 10x over the past 12 months. It's a $1 trillion company. It's good for them to now raise money from U.S. investors. They can get included in the NASDAQ 100 and index funds that are tied to the NASDAQ 100. So that's good. This is a company with $235 billion in revenues this year. Their Q1 26 profit margin, their net income margin, was freaking 70%. Can you imagine that on a $230 billion number? So it's a very profitable business. If you are thinking about buying them, you can buy them today. There's only 3 companies that really do what they do, which is high bandwidth memory, which is going to be a very critical infrastructure block. It's going to be a place where a lot of companies have to buy this kind of high bandwidth memory, and they are the market leader in the space with over 60% share. If you'd asked anyone, hey, what's the most valuable company in Korea for 25 years in a row, the answer would have been Samsung Electronics. But the answer, as of today at least, is SKHY. They're going back and forth with Samsung. So if you look at their price earnings ratio and just forecast out a year, I think they're at about 4 or 5 times PE for 2028, and the same can be said for Samsung. And NVIDIA is like 15 times price earnings for 2028. So just based on, you asked before about valuations and is this market, is it crazy? Is it narrative? Is it based on fundamentals? I think at least with respect to these top 4 or 5 chip stocks, it is very much a game about fundamentals. These are 5 to 7 times earnings type companies. They are all trading at valuations that I think are more than reasonable given their growth rates and given the fact that high bandwidth memory in particular is a real supply infrastructure bottleneck right now and should be for a little while.
Well, somebody who doesn't need a lot of help raising money or valuing the company is Jeff Bezos, and he is raising money for Blue Origin, a SpaceX competitor, at $130 billion valuation for the first ever fundraising round. $10 billion at $130 billion valuation. Is that a big enough hat for you, Aman? Do you like that hat?
It's a good cowboy hat, yeah.
$2 billion from Bezos, $4 billion from Kotu, and they're raising the other $4 billion from the rest of the market. Should be a slam dunk, huh? No problem.
I guess that when you're Jeff Bezos, you can, yes. I think it's this the first time they've taken outside money. I guess he got tired of funding it himself. And when you're Jeff Bezos, I guess the rules don't apply. You can put $10 billion into a seed round and it counts. I think they're very emboldened by what's happened with SpaceX. It's a different business, right? SpaceX has a lot of Starlink revenue, which is consumer and steady and recurring and profitable. They now have a lot of AI revenue from leasing out their space. Blue Origin doesn't really do any of that stuff. They're just putting rocket ships into space, which is all of a sudden the least interesting part of SpaceX's business. But at the same time, I think it has a huge TAM and a huge opportunity. And I think Blue Origin is going to start doing a lot of the same sort of things that SpaceX is. If Bezos knows how to do anything, he took an e-commerce business which we competed against when I was at eBay for years and years and years. And we made fun of them. We made fun of Amazon because their margins were so thin and ours were so rich. And he kind of had the last laugh because he was able to build a e-commerce operating system and a logistics business to power and run the e-commerce businesses of other people in Amazon Web Services. And then he never looked back. And I imagine Blue Origin is doing something similar with the space economy. He's going to build an infrastructure business for space. So it won't just be launching rockets into space, but it'll be everything from launch pads to AI data centers and everything else. And that's very CapEx intensive. So I can understand, why he needs the $10 billion, but I wish him good luck. It's going to be, I think it's a great company. I think they're on their way. I think they are, they've gotten some great investors with Co2, so why not?
I think one of Bezos's oft-quoted statements, whether accurate or not, was "Your margin is my opportunity," referring to Amazon. But I think now he might think that the paraphrasing is "Your valuation is my opportunity," drafting off of SpaceX's IPO for only a tenth of the price, or maybe less.
Yeah, why not? They're both, that space economy is going to yield a lot of winners, and those who can raise money and who have the access to capital as a result have a real competitive advantage in that business. So he can take a lot of share right now in the space race, and if he can do to space what he did to e-commerce with Amazon Web Services and build that infrastructure engine that space needs, I think he'll be very successful.
Is there a problem? No problem.
Well, you're making a face like you got a problem.
I'm sorry that I'm making that face. I don't mean to make a face that seems like I have a problem.
All right, our last story today is about prediction markets, and Kalshi is targeting a raise at a $40 billion valuation. That's a huge step up from where the company was at maybe just a year ago. Notably, Polymarket is also in that category. I think Polymarket now still only valued at 15 billion, so maybe they're falling behind a little bit, although I would expect there'll probably be a future raise for Polymarket as well. But we've seen prediction markets go from, below billion-dollar valuations to above single-digit billions, and now to multiple double-digit billion-dollar valuations in a very short period of time, Aman. I'm sure some of this is being driven by sports betting and prediction markets. Where do you think these end up, and are these continuing to accelerate, or are they slowing down at all?
You're asking for a prediction on the prediction markets?
I know I've heard that predictions are hard, especially about the future.
Yeah, I've heard that somewhere. That sounds like that could be Yogi Berra somewhere on our website. So the last time we really heard from Polymarket in a real way on an equity valuation from like a financially sophisticated investor was Founders Fund back in August of 2025. And that was only $1 billion valuation. But then they soon topped that with a couple of other rounds that were strategics or with debt. And their next valuation was at $10 billion in March of this year. That was both debt and equity. And that was led by Intercontinental Exchange. So, a strategic. And then they got up to $15 billion. And again, similarly, it was valuation raised from Intercontinental Exchange and E1 Ventures. And so I think they are, I would not be surprised if they are, the next announcement will be towards the end of this year, and it'll be close to where Kalshi is talking about it. Kalshi had a little bit of a lead on them because they were a regulated company in the U.S. before Polymarket. Polymarket came into the U.S. only at the end of last year. So they're much later to the American game, and so all the sports betting and all the stuff we're seeing now is still relatively new to them. Their model is a little bit different from Kalshi's. They're a little bit thinner margin, but their technology is fantastic, and it's all decentralized. And I think both Polymarket and Kalshi will do great. The state regulators are the wild card. Like what they do about sports betting and how they regulate it could potentially just throw a spanner in the works, as they say over here in the UK. But it seems like they're over the hurdle with the feds, which is the really big one. And I think both are going to do fantastic. And they're going to, life's going to be very difficult if you're a casino, if you're MGM, if you're doing sports betting, offline, or if you're FanDuel or DraftKings. I think life is going to be very tough with these two now in the market and raising money.
Latest stats that I'm seeing here is Polymarket doing $1 billion in revenue as of June, and Kalshi doing over $3 billion, closing in on $3.5 billion in June.
Yeah.
They've really expanded and I think close to tripled their revenue in just the early portion of this year. So they're both growing like crazy. Again, we'll see whether any increased regulatory oversight slows that down or not. but both companies growing massively, doing incredible amounts of revenue, and also raising at pretty crazy valuations, or maybe
Yeah.
not so crazy based on that revenue.
Well, if those are the revenues, that's not, that's not bad. And I'm guessing sports betting is probably 2/3, maybe 3/4 of the of those revenues for Kalshi, maybe something similar for Polymarket. The worst thing that can happen for any one of those companies is somebody gets caught at the World Cup finals in the next few days, like, shaving points or throwing the game. Hopefully, hopefully that doesn't happen. And as long as they get through that, there's no like 1919 Black Sox moment. I think those companies will do fine.
With us this week is Shawn Bercuson, founder CEO of EarlyAsset Capital. Shawn, welcome to the program. A lot of attention on secondaries, but maybe a lot of concentration of attention on the top companies. SpaceX, which just went public, OpenAI and Anthropic, maybe a few others like Anduril. What's your take on kind of where the secondary market is headed, and what's your secret sauce for what you guys are focused on?
Yeah, so Early Asset Capital, generally speaking, we are a secondary fund, and we have technology called at earlyasset.com. The idea of early asset and our technology is to reduce the friction in the secondary market. We think right now there's a tremendous amount of friction, which is kind of stunting its growth. We think by removing that friction, it will open the aperture for the breadth and depth of the market. So what companies will be able to participate in secondaries going forward, in addition to how many people and which shareholders can also participate in those companies.
Well, before we dive into early asset, maybe you can give us a little bit of a thumbnail on how you got here and where you spent time in your early career, whether that's on the tech operator side, on the investment side, and what experiences gave you sort of motivation to get into the asset class that you're working on.
Grew up in Florida, of all places, and ended up going to landing in Chicago via Vanderbilt University. So went to school at Vanderbilt. After school, graduated with an economics degree. Went to Chicago to be a bond trader, the Chicago Board of Trade. So got my feet wet in the capital markets. Ended up joining a hedge fund private equity shop where I started my first company. It's kind of cliche, but started my first company on a train. On
a train.
I was working in Lake Forest, Illinois, which is about an hour north of the city, but I was young as 24, didn't want to move out of the city of Chicago. And so I had about an hour commute each way. And so just got bored. I didn't know I was an entrepreneur, didn't even know what that meant, but saw a problem and wanted to solve it. It was in peer-to-peer lending. So early days of peer-to-peer lending in the mid-2000s. Would go into work, read TechCrunch every day. That was like my source of information. Ended up finding some engineers in India to help me execute on this vision, and started to raise capital. So went to a few angels back then. Raising VC wasn't even close to what it is today. There was maybe one or two VC groups in Chicago, a couple of angel networks, and really nothing else in the Midwest. And so ended up finding an angel who was interested in my idea, and he introduced me to somebody else who was kind of the quote unquote tech guy of Chicago. So I went to pitch him the idea, and he said, "Hey, look, I like this idea, but I think I like you more than I like the idea. I'm going to buy it and you come work for me." And so this was pre-YC. I was a business incubator at the time, what we would call today a venture studio. Their whole thesis was apply technology to fragmented industries. And my job was to help come up with business ideas and write business plans around them and take them to market, which was at 26 a dream job. If you remember back in 2007, 2008, the economy crashed. Yeah. So it was not a great environment to start new businesses. So they said, "What are you going to do now?" And I ended up joining a portfolio company of ours called thepoint.com, based off the Malcolm Gladwell book, The Tipping Point. And so at the time,
we were part of the Groupon mafia, right?
Oh, well, it was pre-Groupon. So the point So the point is what Groupon became, or excuse me, the point became Groupon. So the point was a social network that binded like-minded individuals around a common cause. And so we would, we were trying to teach people how to use it, and we applied it to group purchasing. We called it Groupon, and I guess the rest is history.
Wait a second. You're skipping over a lot of exciting times and years there. Groupon was not just another startup. That was like the startup for many years, and was really viewed as almost taking over the entire internet at one point. But wasn't that the case?
It was absolutely wild. We at one point, I think Forbes called us the fastest growing company of all time. We hit $1 billion in revenue in less than 2 years. None of us had any idea it was going to do what it did, and it was, everybody, all hands on deck, just holding on for dear life, and it was an incredible experience.
So it turns out there were some pretty smart entrepreneurs in Chicago.
Yeah, there still are. There's some interesting things happening there. I go back often, and it's really neat to see it continue to grow and mature.
So what kind of came out of your experiences there that sort of led you to secondary investing?
I had this problem. So I guess it's important to set the stage. Back then, secondaries were very taboo. To some degree,
right.
It's less so now, but up until maybe 5 years ago, that was probably still the case. One of the reasons it was taboo was in 2012, under the Obama administration, the Jobs Act passed. And what that did was it increased the number of shares private companies could have from 500 to 2,000. So it's not the reason companies stay private longer, but structurally, it's a reason why they can. So back then, people didn't sell for that being one of the reasons, and number two is just culturally it just wasn't that acceptable. But I had this problem, so I was leaving. I no offense to Chicago, but at the time I felt like I was playing in the minor leagues in Chicago. Also, didn't love the winters. I'm from Florida originally.
Right.
So I wanted to move to San Francisco, and if I did that, I had options. And if you leave private companies, you have these options expire within a certain amount of time. But if you exercise your options,
like 90
then you have to
days. 90 days or so, right?
Anywhere from 30 to 90 days. Some companies are starting to extend that window. But generally, I guess the assumption today is about 90 days. So I needed to figure out if I exercise these options, I had a tax consequence. In the eyes of the IRS, it's viewed as realized gain. And I was cash poor, had some options that were worth something, and I didn't want to walk from them. So there was a company at the time called secondmarket.com. They were really the first secondary market
Barry
broker.
Silbert.
So I talked to them. I had nowhere else to go. But I discovered they were kind of a broker, and they wanted to take 5% from me as a seller, 5% from the buyer. And I was all about efficiency, and I'm value driven, as you can tell by my Groupon days. And so I was like, there's got to be a better way. And so I ended up finding a family office out of Georgia to help me, or to buy the equivalent number of shares I needed to sell to pay my taxes. So when I moved to San Francisco, Facebook and Twitter were still private. And that, that excitement had bled over to Groupon and another company, Zynga. So those were the four companies that there was some demand for. So beyond that, people had heard I had sold. And so everyone was kind of interested of like, what is this thing? And so started kind of advising sellers on, who to talk to, things to look for, buyers who were interested in the space, and then companies who were interested or hearing about the secondary market, but needed to figure it out. And like, what is the process? Are we allowed to do this? Long story short, I ended up getting introduced to this one woman who was at a healthcare company. At the time, they had 13 clinics. She had a life event. She needed liquidity, and I was interested in buying the shares. So I went from being a seller to becoming a buyer, and that company turned out to be One Medical, if you're familiar with One Medical. So we ended up doing 30 transactions for One Medical before they went public via SPVs. And then once they went public in 2020, our investors were like, that was cool, go do that again. And so I ended up starting a secondary fund called Bull VC with a few friends of mine.
Tell us a little bit about Bull VC, and where did you start with your thesis on investing? I guess this was in Utah, right? Park City?
Yeah, so I had moved to Park City. My partners I had one partner at the time in San Francisco. He had moved to Boston, and another one in Nashville. And so these are the guys I had worked with on the One Medical stuff. And the thesis was, this was right around COVID. And so companies were all of a sudden staying private longer. The IPO market was open in 20 and 21, but all of a sudden shut pretty abruptly. And so what we were seeing with companies like Airbnb and those types of companies is they needed to figure out, because as companies hit that 10-year cycle, it's usually actually about 12 years. Their employees who have been there for the longest, since the beginning and been there for 10 years, those options expire even if you're still at the company. So there was companies like Airbnb that were trying to figure out, now that the IPO window was closed for them, they were trying to figure out ways to satisfy the issue that they were facing with these employees who had been there a long time with expiring options. And this is becoming a structural thing that a lot of companies now have to think about. Now, previously they didn't have to think about that because exits were happening after 7 to 9 years. But today, fast forward, a lot of endowments and foundations are underwriting venture for 18 to 20 years. And so
I was going to say, yeah, we tend to think about VC funds being 15 plus year vehicles. I know they're structured as 10 plus 2, but the funds that I started at 500 are still, now 14 and 16 years old. So the first 2 funds with some significant assets in there, Canva being one of them, and a few others in other places, Intercom, which just got acquired.
Going back to Bull VC, our thesis was, hey, there's a lot of distressed shares in good companies. And, what does that look like? And can we help these people out that had the problem that I had, and also add value to the company at the same time? And so that's what we set out to do. Now, there was a lot of demand for the top 10 assets. And so our thesis was, there's a lot of, really good companies, but there's no liquid market for it. So if we could focus on those companies, we would have an edge. As a seller or as a current shareholder looking for liquidity, there's a few different things you need to pay attention to. The interest rates, a lot of times are floating or floating interest rates. So if you think that the company is going to have an exit within the next couple of years, that's a great option. If that exit turns out to be a lot longer than you anticipated, it can get more onerous than what you expected going in. And so, as long as you go in with your eyes open and understand what the mechanism is and how it works, it could be a wonderful tool, but it's not necessarily one size fits all kind of thing. One of the structural things that attracts me to this market is, you look back 20 years ago, there used to be 8,000 public companies, and maybe a little bit more than 20 years ago. Today, there's less than half of that, right? There's less than 4,000. And so there's this whole segment.
Although the market cap of that is, now probably 3-5 times what it used to be. So
or more.
Half the number of companies, but probably 5 to 10 times the market value.
Yeah. And to your point about companies needing a certain amount of value to go public, the amount of revenue back then, if you on an adjusted basis to get public, was $62 million in annual revenue.
When you say back then, do you know what the revenue was for Amazon when they went public? I looked this up a little while ago for a research project. This is 1990. This is like 97 now.
I would say less than $50 million.
Yeah, they were like 17 million.
Wow.
And they were priced at 30 times revenue. And like people thought, oh, that's too expensive.
It's crazy.
Like $700 million for this, for this little company. That can't be. But I remember
It was a bargain.
Dave and I were at PayPal, and this is 2002. So this is after the dot-com crash and post, SOX. And so we were getting into a more difficult time. We were just over 100 million when we IPO'd, and the IPO was, was $800 million IPO, right? So it was significant. It felt big, but it wasn't like the decacorn IPOs of today. But it shows you how quickly, or at least how much the scale has changed in those 20 years.
I like to dig. One time I went digging for treasure and I found a half body.
I wonder if you could give us a little bit of your philosophy for early asset. And I think you have a law of 30. What kind of assets are you looking for in terms of companies? What kind of numbers are you looking for those companies?
Yeah, generally speaking, we stay away from binary outcomes. So we do not do biotech. We don't do pre-revenue stuff. Crypto, we're just not smart enough to do that, so we stay away from that.
Sounds pretty smart.
Not smart enough or not crazy enough.
I'll let you be the judge of that.
Right.
So generally what we're looking for is real revenue. We're looking for companies that have product market fit, that are going to withstand the test of time. We're not looking for cyclical companies that, are good trades, but maybe not great investments. So generally speaking, what we tell people is companies have to be doing at least 30 million in revenue as a baseline with 30% year-over-year growth, 30% margins. That's usually Series B plus. The nomenclature has changed quite a bit.
Do you feel like that's enough? I mean, I think we probably started out with similar targets when we were jumping into the market 5, 6 years ago. I think we've had to up those targets a little bit, either on the revenue or the growth, to really get comfortable that these companies will get public within 5 years or get to some kind of exit.
Yeah, that's a great point. Generally, right now, the dynamic is that the demand for liquidity is significantly more than the supply of capital to satisfy it. And so that allows us to go upstream a little bit. We call it our law of 30, but it's really a law of 50. The reason we go to 30, and I'll tell you why. So most of the companies we're investing in are approaching 100 million in revenue. The reason we have we've expanded it a little bit, our aperture, is because there was, back in our bull VC days, there was a company growing 300% year over year with 38 million in revenue, and we passed on it. Now, in hindsight, we should have done that deal, but we were trying to be disciplined, and we said, nope, we got to be at 50, right? Now, on the flip side of that, we're looking at companies doing 400 or 500 million in revenue, and there's a law of large numbers, and so those companies were growing at, call it 40% year over year, and we passed on those. Those are also great companies that we should be investing in. So the law of 30 is kind of our baseline and what we tell people just to give us a little bit more flexibility. But right now, because of the market dynamics and the supply of sellers that are out there right now, we have gone upstream.
Right. So maybe if you could give us an example of a transaction you've done recently, where does that fall in terms of, top 50, top 100 companies, amount of revenue, amount of growth, whether they're profitable? What's kind of a down the middle deal for you guys?
Down the fairway is kind of, are you familiar with a company called DailyPay?
Little bit.
A little bit, yes.
Yeah, so they do earned wage access. The whole idea being the fact that you get paid every 2 weeks is just arbitrary.
Yeah.
And there's a lot of people who live paycheck to paycheck who need their money sooner than that, or need to pay a bill or what have you. And a lot of this has been proven that those employees are happier and they show up to work more often because they're not missing work because they got a flat tire. They're able to pay for different things.
Yeah.
And so this company we looked at was growing a tremendous amount. We believe that they're pre-IPO. They're well over 100 million in revenue. Depending on what how the market acts, and if that window opens more than it is, right now, we'll see what happens after SpaceX and Anthropic and OpenAI, and if they suck all the oxygen out, or if they open up the market.
Right.
But this is
they have been sucking all the oxygen out. I guess the question is, will others take their place, or are they not big enough yet? Because I think once you get those three companies out of the mix, you've got $3, $4, maybe even $5 trillion worth of market value. The rest of the secondary market is a lot smaller. I mean, maybe ByteDance is the one company that's like halfway to $1 trillion, but I think the rest of the market is below 200 billion in value.
Yeah, but you add those up, like there's Stripe, that's probably up there. There's Databricks, so there's still some really good Revolut.
It seems like the market has become more of a stock picking market than a fund investor market. Is that your opinion? I feel like we're in the fund business, but a lot of our clients and customers, they like picking individual stocks and companies.
Yeah, I think that's absolutely true today, but I think we're going to see an evolution here. I think there will still, there's two strategies, right? There are people who are really good at picking stocks, and some of these are clear winners, and you're going to want exposure to those. But really, it's becoming an asset class. And so, what are you going to do? In public markets, are you just picking 4 or 5 stocks and that's your entire portfolio? Or are you picking those couple stocks, but you're also investing in an index and getting a diversified pool of assets? I think they're complementary and adjacent. I don't think it's binary. I don't think it's one or the other.
What's your perspective on the whole SPV market? I guess, it seems like there's been a lot of growth in that market, and then all of a sudden a lot of controversy. I think specifically from Anthropic saying, ixnay on the SPVs. Do you feel like SPVs are here to stay and growing, or they're going to be more scrutiny and oversight?
I think there will be some more scrutiny and oversight, and I think it'll be here to stay. First, let's talk about why they're happening, right? And what happened with Anthropic and SpaceX. These companies are raising more money than we've ever seen before, and not by
huge amounts of money. Yeah,
by multiples of what we've ever seen before.
I think it's only recently that we've seen venture capital funds that are more than $1 billion. That's a relatively last 5 to 10 year phenomenon. Now we have, maybe 10 or 20 VCs that are managing more than 10, 20 billion in assets, but it's not like there's hundreds of VC funds out there writing billion-dollar checks. That's just, even today, that's still a bit unusual.
Yeah, so imagine being in this fund early and having a significant portion. And so when it comes time for pro rata, that pro rata is larger than your entire fund or your entire AUM, right?
I think Benchmark just raised a new continuation fund for a single company that was $400-500 million.
Yeah. So what do, right? So you end up taking your pro rata because why wouldn't you? It's a great company. Everybody wants access. Yeah. And look, SPVs are great because it helps satisfy what the company wants, which is they want a single line item on their cap table. They don't want to have to deal with all these people. So it's like angel syndicates on steroids, right?
I think this is the concern, is that, do the people who are selling you these deals actually have access, to the companies? Are they going to go find access with your money? Or are they going to take your money and go to Rio?
Right. Well, and believe it or not, this was happening in 2010 when Facebook was still private, and there was fraud.
How do you guys underwrite the investments that you look at? Do you get access to financials, or are you comfortable operating without, perfect information when you're making investments?
We approach it the same way any other VC firm with a fiduciary responsibility to their investors does, and we do need to underwrite it in the most appropriate way that we can. If we are unable to get the information that we need to make an informed decision, we'll pass until we can't. And we'll just go to the next one, because there are plenty of investment opportunities out there. And the way that we view this is we have a fiduciary to do our homework. That's why people pay us.
There's no map. It's just green.
No, there's a map there. Look at the monitor.
Right? Oh, God. Ron, where's my leg?
How many companies are you guys diversifying across in your funds? What's your portfolio construction look like?
Generally speaking, we put it into 3 buckets. So we write smaller checks for scout companies, and these are companies that we are starting to establish a position in, where and they're a little bit lower or earlier stage. So this is the Series B plus, somewhere between 50 and 100 million. Then we have core positions. Usually our core positions graduate from our scout positions. And then ultimately we have upsize positions, companies that we have a tremendous amount of conviction in, that we're willing to go up and write bigger dollars or bigger checks for. And there's obviously a lot more volume in the scout positions, a little bit more concentrated in the core, and then obviously 1 or 2 upsize. I mentioned it before. So we have a thing called EarlyAsset.com for, I don't like this comparison, but Carvana for private assets. So what we see
you
is
have companies sitting in a big escalator that's sort of
on the side of the highway.
Right.
So the idea here is there's just a tremendous amount of friction that we talked about in the secondary market between buyer and seller around price. What is my stock worth? And in the private markets, it's a little bit more complicated than just what was the last round price, because there's many different classes of stock. And so we do a waterfall analysis. We value every single class of stock based on the liquidation preferences and the participation rights on the capital structure. You've got it up on screen, secondary OS. Secondary OS is the company side of things. So what we were noticing is that there's a lot of companies that have become allergic to secondaries just because of the volume. And it costs a lot of time, money, and effort to facilitate these secondary transactions. So what we wanted to do is we wanted to address that too, again, to remove the friction, to partner with companies to help them provide liquidity for their shareholders that need it without it being a heavy lift in terms of time, money, or effort. A company could come in, they can approve a transaction, and it goes, and we automate the ROFR process, we automate the closing process for them. And so again, there's just a lot less back and forth. We also provide the legal documentation if they need it. They can use their own or they can use ours. So we put it into 4 buckets to come up with a company valuation before we do the waterfall analysis and understand what every class of stock is worth. And it's basically 4 big buckets. The first bucket is, what are the macroeconomic conditions right now? So for example, if PPI runs hot, that means inflation's hot. If inflation's hot, interest rates are likely to go up. And if interest rates are likely to go up, private market valuations tend to come down. And so we're looking at global macro stuff. Then we basically classify every single company in both public and private. And then we look at similar companies in both the public and private markets. And we effectively put a private company into a public index or multiple indexes or ETFs. So we get a sense for its comparables, what revenue multiple should it be trading at, and what is the exit value. So if this company were to have an exit today, where would it be trading? And then we look at the performance of the company. The big things are revenue, growth, and margins. And how is this company performing relative to its peers? And then they get a premium or discount based on that. And then the last thing is the seller dynamics. So how much are you selling? What class of stock do you have? And what is your urgency? How quickly do you have to move? And so that's how we come up with the valuations of the companies, and then value every class of stock. And then so we basically have 3 different prices that we give you, or that we're looking at. The first is, what was the last round price? It's just something that people like to look at and, say what the discount is based off of that, even though we're looking at apples and oranges many times because they're different classes of stock. Then we say, what is the exit value? If this company were to have an exit today, what would it be worth? And then what is the liquid value? How far are we away from an exit? And are we going to be holding this? And there's time value of money. And so then we do give a discount based on those factors.
The slain civil rights leader was eulogized. Oh, wow. Did you see that? Right on the lens.
Let's maybe step forward to the point where Anthropic and OpenAI have gone public. Hopefully they've returned some capital to the market. What do you see the market looking like in 27, 28?
I think we're about to witness a big evolution in the private market. I think people have tasted what the private market is and are paying attention to it today in a way that they haven't been before. And I think that the wealth channel starts moving in as well. As we're talking to some wealth managers, the interesting thing is, it used to be 60-40 stocks bonds. And over the last 5 to 10 years, it's evolved into 10% alts. Well, they're starting to realize that, more and more need to be allocated to alts. So I don't think it's all going to come into venture secondaries. I think there's real estate. I think there's private equity. I think there's infrastructure, but there is a venture sleeve. And I think all of that just grows. And so what we talked about before is I think that there would be less stock picking and trying to find the winners. And I think it's going to be an allocation to the space via managers. I think what we've seen over the last year, the rich are getting richer, right? The mega funds are getting bigger. They're allowing more access, and people for the first time who have always tried to get into these funds are now able to get into these funds because they're raising more dollars. And I think that, again, that's part of a strategy. But when you're looking at the private markets, you don't want just one strategy. And I think that's the evolution that we're seeing is you're going to want to have some of those funds. Those funds are going to take 15 to 20 years to pay out. Some maybe a little bit less. You might get 100x, but you're also going to want access to other parts of the market. So I don't think we're going to see one strategy. As more dollars come into the private markets, I think it's going to populate a lot more opportunities for all the participants. And then we'll see who's good and who's not, right? There's going to be some that are going to sink and some that will flourish. And I think that it's just time will tell.
I think, both OpenAI and Anthropic are great companies. Whether they're great stocks at the prices that they're being priced at is maybe a question. I'm really more interested in what happens after those 3 high flyers, become public companies and where the rest of the private market shakes out. I think there are definitely some great companies out there. Databricks, Stripe, in particular. We're investors in Anduril. Also, we're holders of Canva. There's some really good companies that I hope will go public in the next 2 years, and we'll see how those play out. It seems like the expectations for public companies have just been set so high recently. I think normally great companies are maybe fearful of going out in the current market, and being compared to those 3 companies. But I do feel like we'll see more reasonable valuations for the stock market, I think, with the next, 10, 20 companies that are going public. Maybe not so much for those 3.
Right now, it seems like it's a bit of a popularity contest. What are the household names?
Yes.
And beyond that, can the public market support some of these other companies? And, with the household names, what we're seeing right now with crazy valuations is it's a lot more, I think Scott Galloway says this a lot, but, is it numbers or is it narrative? And I think we're seeing a lot more narrative than numbers, but some of these smaller ones, but some of these smaller ones truly have to be numbers. Yeah. And if the numbers win out for these smaller ones, I think the window opens a little bit more.
Yeah.
If it's strictly just a narrative game in a popularity contest, the IPO window is gonna continue to be narrow, I think.
Well, I think a lot of our investment thesis for what we call secret stallions, and it sounds like, sort of same thing for some of your Law of 30 or Law of 50. These are companies that we really are looking at, revenue growth, margins, what's the preferred stack of capital, reasonable multiple valuation based on, future cash flows. It's kind of boring and it's kind of Buffett style, management, investment management. But I think there's only so many narrative stories that the market can support. And maybe even those narrative stories aren't supported forever.
Yeah, you call them stallions. We call them thoroughbreds. Because, unicorns are kind of these mythical creatures. And the question is, are they really truly worth $1 billion? But stallions and thoroughbreds have kind of proven themselves, right? And so, that's what we're looking for, these companies that are going to withstand the test of time.
Well, Shawn, thanks for spending some time with us. Really appreciate the insights. I guess for folks who want to take a look at early asset and secondary OS, you guys will do, I guess, on the spot valuations for folks, assuming they fit the criteria for the companies you guys are looking for, right?
Yeah, it's all conditional based on the information that we have. But if you're looking for liquidity, then, we do a little bit deeper dive. So we may have to adjust the price based on what we figure out. But yeah, we do our best to get you a good indication of price for the assets that you hold in the private markets.
Awesome. Well, thanks for spending some time with us, Shawn, and look forward to hearing more about early asset.
Thanks, guys. Really appreciate it. Have a good one.
Welcome to Valuation Corner for this week. We're going to be talking about Reflection AI. This is the third now in an installment that we're doing on essentially open weight LLMs and models and how they're competing with closed source AI companies and creating a viable alternative for customers, but also just pressuring the unit economics for what some of these closed source providers are doing. The last one we talked about was DeepSeek. They're out of China. This one is the American equivalent, the leading now, perhaps the leading American open weight LLM model. Let's talk about Reflection. So they're a large-scale AI model provider. They just announced in earlier this month a $25 billion valuation. Disruptive was the major VC behind it. They had raised a couple of $1 billion back in October 2025, so only about 8 months ago, and they'd done that at a $6 billion valuation. So they've essentially quadrupled their valuation in a very short amount of time. They're only founded in 2024. Excellent investors along the way. Lightspeed was the early initial investor in the Series A. The seed had been done by Sequoia alongside CRV. So just a host of very, very impressive investors along the way. The technology has been vetted by some of the best. How do you evaluate a company like this? Well, we'll talk a little bit about the team. We'll talk about the technology. We'll talk a little bit about their go-to-market, how they make money, how you do it with early stage and mid-stage companies, right? Pretty classic playbook. Let's start with the team. Their CEO is Misha Laskin. If I had to come up with a perfect CEO profile for an AI company, I would probably say have the CEO be technically strong, the computer scientist who worked for Google Gemini. That's like perfect training for this kind of thing. Maybe give him a bachelor's degree in, I don't know, theoretical physics. Maybe give him a PhD in the same, have him go to places like Yale and University of Chicago, maybe put a pedigree on him. Just, working for Gemini is a great pedigree. Maybe give him a Y Combinator brand, maybe give him a Forbes 30 under 30 brand. And then partner that person with excellent investors like Lightspeed and Sequoia. Doesn't that sound like the perfect AI CEO? He's partnered with the CTO, Ioannis Antonoglou. He is also a DeepMind employee. He was employee number 25. He had a 12-year tenure at DeepMind, and he's created some of their algorithms like AlphaGo and MuZero. So basically, it's an A+ founding team with technical talent from Google and DeepMind, and they have the credentials from Gemini and Y Combinator. So excellent team. Reflection just signed a deal with SpaceX, a $6 billion compute deal. If you're wondering where all the money they're raising is going, it's going right over to Elon Musk and SpaceX because they need a lot of compute to generate their open weight intelligent models. Let's do a comparison of them between DeepSeek, which we covered last week. DeepSeek is the Chinese version of a deep thinking machine. The American Reflection AI is like the American equivalent. And I'm using here the Betsy Ross flag for the US because it is around our Independence Day, so I'm going traditional. DeepSeek is running at something like $200 million in revenue. I'm putting a big asterisk next to that because we don't know exactly what their revenue is. They're a little cagey in terms of what their monetization looks like, but they have released some information about the number of users and the monetization. And so we can infer from that they're running at about $200 million. The multiple on that, if you just do a pure EV to sales multiple, is 250x, which is in the land of crazy. Reflection, I don't think, is even at 20 million in revenue. They're generating different types of revenues than what DeepSeek does. They're going mostly after SaaS revenues, and they're getting that mostly from Fortune 500 or at least larger U.S. enterprise clients and from the U.S. government. So it is a higher quality of revenue than DeepSeek. DeepSeek is really focused on monetizing at rock bottom API rates and pricing 60 to 80% underneath where their competitors are. So different type of revenue, maybe different quality of revenue, maybe give Reflection a plus on that. But even then, at that valuation, they're probably about 1,000x a multiple of EV to revenue. So they are definitely, you're definitely not buying current revenues or current performance. You are all betting on the future. Governance, DeepSeek is a Chinese company. They raise money from really only Chinese investors, a few international cross-border investors. Reflection is raised from an A-plus list of American investors, from SKHY to Lightspeed to CRV to NVIDIA. Their valuation is about half of what it is at DeepSeek. So you're paying a premium in terms of the multiple on revenues, but the valuation is a lot less. Okay, let's talk about China DeepSeek and why I'm equivocating and hedging a little bit on what we think the revenues are. They claim to have a theoretical cost-profit ratio of 545% per day, and they claim that if they monetized all of their traffic at their current market rates, they'd be generating around 200 million in revenue. Now, claiming that if you monetize a certain traffic going through your system at a certain rate, theoretically you get to 200 million. That's not exactly like, hey, we delivered $200 million in GAAP revenue. So you got to take whatever you hear from Chinese companies in generally with a grain of salt. And certainly this kind of equivocation doesn't inspire a lot of confidence. So let's just hedge all the revenue numbers from DeepSeek and maybe even Reflection AI with a little bit of salt. That said, the question is now, where does Reflection AI fit in the grand scheme of things, and can they be a credible player in the space? This is a map that I'm going to run you through. I think every CFO in tech right now is building some map just like this. On the y-axis is an AI index. Let's call it a index which demonstrates efficiency, quality work, like how well does this stuff work for the business needs that I have. And then on the x-axis, this is the cost in order to run intelligence. And so somewhere on this axis, there's going to be a whole bunch of players. So I'm going to start with a quadrant, a top left quadrant. That's the value spot. That's sort of the sweet spot where CFOs really want you to be. Low cost, but high efficacy. Let's start with Anthropic's players. So Fable 5, which is recently back in the market. Claude, and then Opus 4.8 and Claude Sonnet 4.6 are there other major models. They're definitely expensive, but they're the leaders as far as the efficient frontier for what most large-scale companies need for much of their work. Not all of it, but if you are looking for the best-in-class model out there, the Ferrari, if you will, you're going to pay a premium for it, but it's going to work really, really well, right? The other players out there, so ChatGPT 5.4 and 5.5 are definitely players out from OpenAI. And then I'd say Gemini is in the game, and you pay a little bit less for them, and you don't maybe get quite as much, but they also fit along this efficient frontier if you kind of map value and what you're getting for it. Now here come the interesting ones. You got Kimi, K2.6, which is in the game. You've also got now DeepSeek, which has a couple of models, their Pro and their Flash, and then Minimax. They're all potentially landing. Hey, you don't have to pay a lot for this stuff. It works well for a lot of what you need. It's not necessarily the Ferrari, but it is a high quality, cost-effective model for a lot of what companies need. We've also got a couple of other now principally Chinese players. So Xiaomi has MIMO version 2.5 Pro. Definitely feels like that's in that value bucket. You've got Z.AI with a couple of models that I think are also very cost effective. Again, not delivering quite what Claude does, but doing it at a fraction of the price, probably 10% of the price. And so again, for a lot of corporate functions, this is going to be useful. And then you have a couple other players who are in the game. You've got Nemotron, which is the new model from NVIDIA. They're definitely open source. You've got Grok 4.3. I'm going to say that's closed source. That it may surprise a lot of people. Elon Musk is a big promoter of open source in general. The early Grok models were open source, but Grok's latest incarnation is definitely closed source. So, these are examples now of where some of the open players like DeepSeek and Xiaomi's Mimo and potentially what Z.AI are doing are all providing a high degree of efficacy, but at a fraction of the cost of the closed source players like Claude and where OpenAI are delivering. So every CFO is going to come up with some matrix like this. Really, the question for reflection is, hey, where do you land in this matrix? Because every CFO and every CTO are having this conversation. So reflection doesn't do an LLM exactly. So they're more in the land of coding assistants and coding agents. So let me just do an illustrative map for what this looks like. This is going to be different for every company because every company has different needs. Some need to be on the cutting edge. Some will be able to use different, regulated industries are going to operate differently from unregulated industries. Some coding assistants will be able to work better for an industry like healthcare or for financial services or maybe for a venture capital firm that are both for other industries. So I think that's why I'm saying every CFO has to come up with their own map of this. I think you've got Claude Code, which is going to be very expensive, but will work very well. You've probably got Cursor and OpenAI Codex in that conversation. If you're willing to trust the Chinese with an open source model that you can use to kind of create your own custom open weights, I think DeepSeek is in the game. OpenHands is another player who's in the game. Poolside, which has been very, very good for regulated industries. And the question really is now, can Reflection AI end up in that top left category as well? It's a little early to call it, but my sense so far is they're definitely in the game. They're definitely a player to be considered very seriously, and they have a big advantage because they're an American, they're not Chinese. They've got different governance, and you've got a different set of investors. So very well capitalized company, which I think will work for a lot of US players. So we should keep an eye on them. I think it's a company that can go a long way. As I said, every CFO is going to be mapping them against these 4 or 5 or maybe now 7 or 8 competitors. With the funding that they've got and the investors that they've got, they are definitely one to keep your eye on. And because they're in the US, you can invest in them as American investors, and in the secondary market, you can't really do that in China. So that's the overall scoop, I think, on Reflection. Definitely an up-and-comer, somebody to be taken very seriously.